And now, peer-to-peer lending. Peer-to-peer is basically an online dating service for money. It matches people who need cash with investors prepared to lend it. More than 500,000 borrowers and lenders use it, and in the first 3 months of this year, peer-to-peer loans topped £1 billion for the first time. Now, peer-to-peer bypasses the banks, though it is now regulated, and the idea is that borrowers can get lower rates than they would from a bank, while lenders are attracted by higher rates of return on their spare cash. But recent problems and changes have made people wonder just how safe and how healthy peer-to-peer lending is. Well, Christine Farnish is with me. She's chair of the Peer-to-Peer Finance Association, whose members form more than half the industry. So, Christine Farnish, what rate of return do people who lend money get?
Well, it depends on whether you're lending to consumer borrowers or small business borrowers. Those are the two main types of borrower. It'll be slightly less if it's consumer borrowers. It'll be somewhere between, at the moment, about 3 and 5%, but that's net of bad debt losses and it's net of any fees and charges. So it's a realistic measure rather than one which is perhaps less transparent in many other parts of the investment market. Yeah. If you're lending to small businesses, you'll get a little bit more, and the platforms do vary, and it depends a lot on how much risk you want to take. You know, the golden rule of finance is always the balance of risk and return. If you take a bit more risk, you're not going to get, there's a chance you won't get it back.
Yes, if you take a risk, you don't necessarily get a return, though, do you? Because it wouldn't be a risk then. The danger is, though, that this is seen as an alternative to cash, isn't it? People have got cash, they think this is a safe way of getting a bit more, but it isn't completely safe. What if things go wrong?
Well, it's not an alternative to cash in the sense that it's not deposit guaranteed. Banking is safe in inverted commas, but of course, if 2 or more banks fell over, as we all know, it wouldn't be safe and taxpayers would have to bail them out. And
Sure.
Of course, you face inflation risk as well, which at the moment hasn't been a problem for some years, but, that's not going to stay like that forever.
But there's no compensation from the financial services?
There's no financial services compensation scheme cover.
All right. Well, also here is Roger Gewolb, founder of the Campaign for Fair Finance. So, Roger Gewolb, are peer-to-peer lenders fair finance?
I think in the main they are, but I think there are, as you said, problems emerging right now that both the media and the regulators are getting more and more worried about.
What are those problems in your view?
I think that, first of all, there's the question of transparency and lack of standards and best practice. Different kinds of peer-to-peer lenders operate in totally different ways. They're very much all over the place. To a large extent, they aren't even peer-to-peer. Some of the largest lenders have brought in insurance companies, pension funds, and other institutional lenders. It's kind of like Lenny Henry flooding Airbnb with premier in-rooms. What happened to the business model? What does that do for the social good?
Now, last year, the FCA, the regulator, voiced concerns about what are called provision funds. These are amounts set aside which are intended to cover losses if some of the borrowers default. But in a paper, it said having them may obscure the underlying risk to investors. Is this what you meant by not being clear, that you've got these funds, but they may not be clear to investors what they are and what they're worth?
Well, some have the funds and some don't. And the Financial Conduct Authority has announced rather recently that people should not have provision funds, in order that depositors, I'm supposed to call them investors, they tell me, in order that investors not be misled to thinking that they're protected by a bank. I find that very hard to understand. I can't imagine a lender that would make loans without a provision for bad debt.
Yes. Christine?
Well, the whole point of these platforms is that the platform has to be good at and know what it's doing in terms of managing that credit risk, because anyone who lends money needs to ensure, as far as anyone humanly can, that the people who borrow can pay it back. The evidence so far suggests, and these platforms have been going since 2005, don't forget, the evidence so far suggests that platforms are just as good as the banks at managing credit risk, and they use exactly the same data. I mean, it's not in anyone's interest to have bad debts building up and then the whole thing going bust.
Why are the rates different then if they use exactly the same data and the same?
Because they offer different products and they're catering for different investor communities. So some investors, some platforms take as little as £100 or £10 even from consumers, lend to consumers, spread it across 100 consumers, and they're very, very careful about who they lend to. Others will have a bigger appetite for risk, and they'll make that clear on the platform.
But the banks are cutting back on unsecured lending, aren't they?
Yes, they are, because
they have to. And the FCA says it will do this even as Christmas approaches. But your firms, your businesses, seem to be expanding it just at the time when banks say it's too dangerous for cutting back.
They're growing steadily. They're not growing at a huge, rapid rate. They're still being extremely prudent about who they lend to. And they do publish all the information about their bad debts. All our members have to do that to a standard methodology. We think the FCA should make the whole sector do that, by the way, so no one can cheat and pretend they're better than they really are. I mean, these platforms are more transparent than any other part of financial services, and there's nothing like the disinfection of sunlight.
Yeah, yes, but the FCA says that some firms have plans for wind down in the event of their failure that are inadequate. It doesn't really encourage you to lend if they don't have an adequate plan if they fail.
Well, it's the FCA's job to make sure they do have an adequate plan. That's one of the rules that they've imposed.
Roger Gewolb.
Well, I have to question the principle of transparency. I think that some of these platforms are very transparent and some aren't. As I said on this program some months ago, some firms publish the details on all their loans, the amount, the interest rate. Publishing all of that information is, like I said, going to the GP who tells you you've got a bad back and then he gives you the x-ray to take home and analyze. It's dissembling. They're not really transparent, a lot of them. But the biggest problem with peer-to-peer lending, I think, is that it is something that should definitely exist. The big banks, we need an alternative to them. It's complementary. But we need standards. We need best practice.
Christine.
Well,
briefly.
That's exactly what the P2PFA does. We've got a number of rules in place that we think the FCA should adopt. For example, our platforms can't discriminate between wholesale and retail investors. They have to be fair to everybody, and they have to manage that credit risk properly.
Christine Farnish and Roger Gewolb, thanks very much.